All right, welcome to The Explainer. Today we're going to do something a little different. We're taking one single company, Raymond James Financial, and putting it through the ultimate test. We're going to analyze it using the playbook of, well, one of the greatest investors ever, Warren Buffett.
So our mission here is pretty straightforward. We want to see if this financial services firm can clear the incredibly high bar set by Warren Buffett himself. Does it actually make the cut? Let's find out.
Okay, here's how we're going to break this down. Think of it kind of like a detective's case file. We'll start with the rules of the game, the Buffett checklist. Then we'll look at the good stuff, the bull case. And then the not-so-good stuff, the bear case. And after all that, we'll deliver our final verdict and boil it all down to the one key takeaway for you.
All right, let's dive in. To even begin to know if Raymond James is a Buffett-style stock, we first have to understand the four key principles that guide pretty much all of his decisions. These are the rules of the game.
Think of these as four major hurdles. First, is the business simple? Can we actually understand how it makes its money? Second, does it have a durable moat, some kind of long-lasting competitive advantage? Third, and this one's a biggie, is its balance sheet strong, with very little debt? And finally, is it cheap? Is it trading at a bargain price? To get a thumbs up today, Raymond James has to clear every single one of these hurdles, no exceptions.
So let's start by building the case for buying the stock. Because when you look at the company's performance, it's really easy to see why somebody would get excited. On the surface, this thing looks like an absolute powerhouse.
First off, just look at this growth. Over the last 5 years, the company's net income has grown at a compound rate of nearly 20% a year. I mean, wow. In an industry that can be super cyclical, that kind of steady, powerful performance is exactly what Buffett loves to see. And this number right here, it illustrates the quality of their business perfectly. A gross profit margin over 85% tells you this is not just some run-of-the-mill stockbroker. This points to a really powerful brand, probably built on trust, that lets them capture incredible value from high-margin stuff like wealth management.
Its return on equity, which is a key measure of profitability, is clocking in at over 16%. Now, this comfortably clears a classic benchmark that Buffett himself often uses to define what he considers a good business. So far, so good, right?
And get this, for 13 years straight, management has rewarded its owners by upping the dividend. This is a huge sign of financial discipline, and it shows you've got a team that thinks like an owner. That is absolute music to Buffett's ears.
And then there's this jaw-dropping number. Based on its cash flows, it looks like the company is trading at a 50% discount to what it's really worth. It's like finding a high-performing, shareholder-friendly company with a half-off sales sticker on it.
So, based on all that evidence, it seems like an obvious buy, doesn't it? An amazing business at a bargain price. But hold on. Let's pivot over to the balance sheet, because that is where we find a very, very different story.
Well, with numbers that good, there's almost always a catch, isn't there? And in this case, the catch is hidden deep inside the company's financial structure. It's not obvious from those performance numbers, but trust me, it's a big one.
And here it is. The company is highly leveraged. Its debt-to-equity ratio is 5.19. To put that in perspective, Buffett usually considers a ratio above 0.5 to be high. This is more than 10 times that limit. The company is walking a financial tightrope. And here's why that debt is such a big deal. Remember that fantastic 16% return on equity we saw earlier? Turns out, it's not all coming from pure operational skill. When you strip out the effects of all that debt and you look at the return on invested capital, it's a measly 3%. That massive gap tells us that the high ROE is being artificially goosed by borrowing, a classic red flag.
And it gets worse. The company's quick ratio is just 0.25. So, in simple terms, for every dollar it owes in the short term, it only has 25 cents of cash ready to pay up. In a sudden market panic or a credit crunch, a company with that little cushion would be in serious trouble. That's a type of risk Buffett absolutely hates.
And look at this. All that talk about consistent earnings? Well, the company's free cash flow, the real cash it's generating, has dropped by over 37% in the last year. This kind of volatility runs completely counter to Buffett's desire for predictable, steady owner earnings.
So the crucial point is this, and the source material puts it perfectly. This company has a Ferrari engine. You see that in its profitability and growth, but it also has a loose steering wheel and worn-out brakes thanks to that massive debt and weak liquidity. The performance is impressive, sure, but the underlying vehicle is incredibly risky. So, after weighing the powerful engine against those very, very risky brakes, it's time to step into Buffett's shoes and make the final call. Does Raymond James Financial make the cut?
The verdict is a clear, resounding no. Based on his historical principles and everything he's ever said, Warren Buffett would almost certainly pass on this investment today.
The deal breakers are just too significant. The extreme leverage, the high liquidity risk, and that recent free cash flow volatility, it all creates a level of risk and unpredictability that simply outweighs the impressive business performance and a cheap price.
But here's the interesting nuance. While Buffett himself would likely pass, you gotta wonder if one of his investment lieutenants, who might have a slightly higher tolerance for risk, could be very tempted. I mean, that 50% margin of safety is a value investor's dream, and that dividend history is a powerful signal. They might just take the bet.
So after this whole investigation, what's the big lesson here for us as investors? What should we take away from this?
This case really highlights a critical lesson: the difference between a good company and a good, safe investment. It's so easy to get excited by a powerful engine, the high growth and the big profits. But as an investor, you're buying the whole car. So the most important question you can ask yourself is this: have you checked the brakes?